Secretary Bessent recently remarked on Bloomberg Surveillance that any plans to term out U.S. Treasury debt, i.e., issuing longer-term bonds instead of maturing them quickly, remain way off the horizon. He explained that under today's lavish menu of economic uncertainties, rising inflation and the Fed's quantitative tightening program, the government must simply see what the market wants. Loving the ambiguity, Bessent's path-dependent phrase has since become our economic catchphrase. It's as if he's telling us, we're not on a fixed track, folks, we're dancing according to the market's sly rhythm. But behind the carefully poised public speaking lies a more insidious truth. The persistent Bidenflation, as our dear secretary so wryly dubs it, continues to shape the U.S. debt landscape. Critics have long argued that previous administrations, notably under Janet Yellen, purposefully skewed the Treasury's portfolio toward short-dated bills to artificially suppress longer-term yields. By doing so, they effectively propped up economic growth figures and padded the narrative before the elections, whatever illusion sufficed to muster political support. Now, despite Bessent having publicly criticized that very strategy, he's, with a politician's nonchalant shrug, said that the current plan retained the Yellen team's approach. In plain English, we like what we've got, and we're sticking to it, at least until the market sneezes in a favorable direction. One might quip that this is the classic case of, if it ain't broke, let's break it anyway. What's our takeaway? Policy decisions appear to be less about rigorous long-term economic planning and more about political expediency and reactive adjustments. The government, much like a dinner guest at a party who only eats the canapés when someone else passes out the appetizers, has to wait for the market signal before committing to longer-term debt sales. And like any good dinner guest, the Treasury is hoping that when the inflation tide recedes, it can gracefully slither into its planned strategy, if not too wet from last night's overspending. As if the delayed strategy for issuing longer-term treasuries wasn't enough to ruffle feathers, Bessent reminds us that the Federal Reserve is itself shrinking its balance sheet, like a diet-conscious bear after a hibernation binge. With the Fed offloading treasuries they've been hoarding from their pandemic-era bonanza, we now have dual sellers in the marketplace. Picture two competing vendors at a yard sale, one desperately trying to unload items acquired during the good old days of easy money, and the other cautiously pricing them for future value. Their simultaneous presence complicates any attempt to extend the duration of Treasury debt issuance without wrangling yield increases that might as well be on the menu for a secondary course of inflation. According to the latest market data, the 10-year Treasury yield has ticked down by about 4 basis points to 4.50%, a clear nod to how markets react when central banks and treasuries engage in a delicate balancing act. Compare this to pre-pandemic times when yields languished below 2%, a reminder that charm-offensive policies have given way to hard-hitting fiscal workouts. Simply put, we're in uncharted territory, a period where fiscal and monetary policies are not only out of sync but are also engaging in a kind of economic tango that leaves the rest of us scrambling for the first aid kit. The Fed's hinted pause on its balance sheet runoff is significant. It dramatically simplifies the Treasury's task when it's not facing a competition for market liquidity. This interplay between policies reveals a deep-seated coordination, or, dare we say, a cozy cartel, of macroeconomic management. But more cynically, it reflects a world where policy signals are as clear as a foggy winter morning. Who knew that fiscal responsibility came with such delightful ambiguity? No economic commentary would be complete without touching on the elephant in the vault, U.S. gold reserves. At $42.22 per ounce, a price frozen in time courtesy of legacy pricing, the current market valuation lags spectacularly behind what could be if we revalued gold today. In theory, recalibrating gold prices to current market conditions could inflate the reported value of our reserves from a meek $11 billion to a stunning $750 billion. Imagine that fiscal muscle flex. Yet, Bessent firmly dismisses suggestions of monetizing the balance sheet or revaluing gold, repeating, with the kind of gravity usually reserved for delivering cabinet secrets, that revisiting the gold price is not what I had in mind. If that isn't political double talk at its finest, what is? It is as if the government prefers to keep its golden goose in a pen labeled vintage pricing, rather than letting it strut free in the marketplace. Meanwhile, senators and financial pundits are left clamoring to visit Fort Knox to verify that the treasure is indeed there. It's a bit like being invited to a magic show where the magician insists you call it econometric wonder, as he deftly hides the ball behind his hand. When critiquing the fiscal management underlying our sovereign wealth and gold policy, one cannot help but see this as yet another symptom of the government's reluctance to engage in genuine structural reform. Routine revaluations, and hopefully some rebalancing, could provide both a more accurate picture of fiscal health and a fiscal bolster for future expenditures. However, once again, the cautious tug-of-war between market expectations and political expediency leaves us with a status quo that favors the familiar over the transformative. In a multi-country economic circus, the United States isn't the only performer on the stage. Bessent, in his ever-comfortable global stance, shifted focus to China, warning that the world's second-largest economy is dangerously unbalanced. The message is clear: while Washington debates monetary policy acrobatics, Beijing finds itself teetering on an economic tightrope, dangerously reliant on exports to prop up growth when domestic consumption desperately needs a boost. A recent spate of data underscores these concerns. Chinese exports, while robust in isolation, have struggled to offset an aging industrial base and mounting debt levels. The country's latest GDP figures reveal sluggish household consumption growth, a vital signal that the rebalancing away from export dependency isn't happening fast enough. Vice Premier He Lifeng and his counterparts have previously met with Yellen, yet substantial policy shifts remain as elusive as a unicorn in a bamboo forest. The irony of the situation is as thick as a Beijing smog. While the U.S. dabbles in debates over Treasury durations and gold revaluations, China is wrestling with structural issues that require deep-seated reforms. The ubiquitous capital controls, which aim to stem the outflow of funds, might finally erode consumer confidence if they don't lead to a more open and resilient financial system. It's a reminder that economic policy, when played like political chess, can often become more about managing optics than securing long-term stability. No modern financial commentary would be truly complete without a nod to our favorite interloper in the world of innovation and controversy, Elon Musk. Bessent's endorsement of Musk's cost-saving initiative, dubbed the Doge Efficiency Drive, brings a curious twist to the debate. Contrary to the criticisms that have flooded the airwaves, Bessent lauds Musk's unbelievable energy level and even compares him to sports legends like Michael Jordan or Lionel Messi. Here, we glimpse a curious blend of carbon-fueled optimism and fiscal rhetoric, underscoring the belief that cutting costs on one front could potentially catalyze fiscal discipline on another. The crux of the argument is this: as Musk's innovative endeavors, even if veiled in the absurdity of Doge references, usher in cutting-edge efficiency and cost savings, the benefits could theoretically trickle down into broader economic policy, curbing spending and stabilizing yields. However, this optimistic projection rides on the assumption that business ingenuity can replace, or at least temper, the institutional inertia that has traditionally bogged down government reforms. In a time when fiscal mismanagement has been the order of the day, invoking a tech mogul's prowess as a panacea for structural economic issues might be seen as nothing more than a high-stakes bet on celebrity capitalism. What have we learned from our protagonist, Scott Bessent, and the Treasury's approach to multifaceted economic management? The answer lies in the delicate dance between policy flexibility and structural rigidity. Straddling the fine line between market-driven decisions and politically expedient reforms, the Treasury, and by extension, the government, has managed to transform a series of complicated policy choices into an elaborate performance art. In this performance, phrases like path-dependent and monetize the balance sheet serve as cryptic mantras designed to placate markets while obscuring the deeper issue, the absence of resolute, forward-thinking fiscal discipline. Let's summarize the current state of affairs with some hard-hitting data and observations. 1. Treasury issuance strategy. Despite the persistent inflationary challenges, with CPI data indicating that inflation rates remain stubbornly above pre-pandemic targets across many categories, the government retains a short-dated debt issuance approach that many argue artificially suppresses yields. This short-term strategy, reminiscent of last-minute election hustles, suggests that substantive long-term fiscal planning still remains, quite literally, a long way off. 2. Fed Treasury coordination, or lack thereof. The Fed's ongoing balance sheet runoff, a tactic intended to normalize monetary policy post-pandemic, adds another layer of market complexity. With long-term Treasury yields currently hovering at levels significantly higher than the sub-2% era of yore, we must ask, can we truly afford to be playing catch-up in an economic race where every basis point counts? 3. Gold reserves and fiscal realities. While the potential revaluation of gold could fortify the balance sheet by hundreds of billions of dollars, the government's reluctance to disturb the status quo leaves a proverbial golden goose untapped. In a world where fiscal deficits continue to widen, with the national debt now having surpassed $31 trillion, the decision to sideline such a lucrative policy tool speaks volumes about our priorities. 4. Global economic imbalances. China's unfortunate reliance on exports amid waning domestic consumption serves as a sobering counterpoint to U.S. efforts to maintain a strong dollar and a stable treasury market. As recent trade data and GDP forecasts reflect, the Chinese economy faces its own maelstrom of structural challenges, underscoring the interconnected, yet asymmetric, nature of global economic policy today. 5. Technological efficacy versus institutional inertia. Finally, the invocation of figures like Elon Musk, and the odd mention of Doge efficiency, symbolizes a growing trend where unconventional forms of market wisdom are being juxtaposed against centuries-old fiscal dogma. Whether this signifies a new era of policymaking or merely a curious sideshow remains to be seen. In summation, while the Treasury under Bessent may be politely waiting for the market's cues before changing strategy, it is clear that such inertia in times of economic turbulence is akin to piloting a ship through stormy seas by simply hoping the winds will change direction. For many, this approach isn't just imprudent, it's the epitome of modern bureaucratic complacency. As we watch governments navigate these treacherous economic waters, whether through dance-like policy adjustments or high-wire acts involving gold reserves and celebrity-led efficiency drives, one thing remains indisputable: the current economic regime seems more committed to preserving the status quo than to pioneering bold new reforms. And in the grand spectacle of financial policy, where every word is measured and every pause has a hidden meaning, ordinary viewers and finance professionals alike are left to wonder: are we in the midst of a carefully orchestrated performance, or merely a series of calculated missteps in the art of economic management? Until the next act unfolds, we remain ever vigilant, ever satirical, and ever ready to decode the economic signals behind the grand stage of public policy. Stay tuned, stay informed, and remember, when it comes to the economy, sometimes the best strategy is to laugh at the absurdity while arming yourself with data. After all, in the kingdom of fiscal fools, knowledge remains the only true asset.